My name is Michael Duke, and this is the show where I talk about stocks that are interesting. So if you find that interesting, please consider liking the video and subscribing to the channel. Today, we're going to be talking about Kimball Royalty Partners LP, ticker KRP. As usual, I'm going to be giving an overview of the company, taking a look at the financials, taking a look at the valuation and the dividend, as well as discussing some of the risks and doing some technical analysis. And then, as always, we'll conclude with a grade, buy, sell, or hold. So, without further ado, let's get into it. It's not a stock, it's an MLP, Master Limited Partnership. I've covered other MLPs on this channel before, such as MPLX. Anyways, a Master Limited Partnership, for those that aren't aware, is basically a publicly traded LP unit. If you've ever invested in a private investment as an LP, you're a limited partner. You don't have any sort of operating responsibility when it comes to the thing that you're invested in. However, you receive a split of the profits and losses. So it's an equity-like investment, although typically you do not have voting rights in a master limited partnership. So usually companies that are organized or have units, they're units, not shares. Companies that have units on the open markets as MLPs are usually energy companies. And the reason why companies organize as MLPs is because they don't have to pay any income taxes, and the limited partners instead bear the tax liabilities. Therefore, if you're invested in an MLP, you receive a K1 from the general partner or the sponsor of the master limited partnership, and you make sure that you file that with your taxes. Oftentimes, there's a lot of depreciable assets. They're real estate-like investments. A lot of all pipeline companies are usually MLPs. A lot of energy companies like KRP, which we'll dive into in a second. So typically a master limited partnership is going to have a dividend, and they are required to pay distributions, not dividends. They are required to pay distributions of a certain amount of their earnings. I can't remember what it is. They have to do that because they don't pay taxes. Therefore, they have to distribute that cash flow so that partners can pay for taxes and receive a little coupon. So anyways, what is Kimball Royalty Partners? Kimball Royalty Partners is a mineral interest aggregator. They buy up mineral royalty interests in oil and natural gas properties in the United States. It's based in Fort Worth, Texas, where I used to live. Obviously, Fort Worth is a big center for oil and gas. This is a pure play investment vehicle to give investors exposure to commodity prices of oil and natural gas. So the reason that one might invest in Kimball Royalty Partners is because you want exposure to the oil price. So oil has interesting properties, right? One might want exposure to oil as an inflation hedge, because although the price of oil has it tends to be lower today than many points throughout history on an inflation-adjusted basis. The reason it's seen as an inflation hedge is it oftentimes is driving a lot of inflation. Therefore, when inflation is going up and like stocks are selling off, bonds are selling off because of inflation, oil happens to be higher during that regime sometimes. And you can tell that by looking at this chart. This is the crude oil price of WTI crude just over time. You see, some of the big inflation shocks of history, notably in the 70s was a huge inflation shock. That was driven by the oil price, right, where OPEC basically drove up the price of oil. So oil was the cause of inflation. If you had exposure to the oil price in your portfolio, you would have hedged that inflation. You see that oil was 3 something a barrel, and it more than 10 to 13 times in over a decade, and then it basically sold off from there. But all throughout the 2000s, it went on a tear. It was back down near $11 a barrel. Remember here, 39 a barrel here, $11 a barrel here. So over 20 years, it lost 70% of its value, but 10x'd again. It 10x'd from that point, more than 10 times. And then the deflation of the global financial crisis really changed the price. Of course, we know that in COVID, the price of oil actually went negative. That chart doesn't really reflect it because it happened on a single day, but the price of oil went negative due to oddities of the derivatives market. But we see here, oil again reached over 100 a barrel in the most inflationary time period we've had since the 70s, which is like the post-COVID zero interest rate era here. It has since lost about 30% of its value from the peak. So oil is obviously a very volatile asset. It's very geopolitical. There's a lot of reasons why it's often a good thing when oil prices are low. It's better for the economy. It's better for just about everybody that is not a royalty interest owner or an energy producer. But low energy prices are of strategic importance for the economies and governments of the world. So again, why would one want exposure to that in their portfolio? Again, because it just so happens that throughout a few of these periods where oil was really going up, that stocks tended to be selling off, and it's a commodity that will diversify a portfolio, but it's moderately correlated to the S&P 500 as well. So that's kind of the underlying thesis behind why one would want exposure to oil and gas. Now, there's a lot of reasons why you wouldn't want exposure to oil and gas. It's 60 something today, 63, 64. You see here adjusted for inflation. We're in the middle of the inflation adjusted range. So it's definitely not anywhere near the highest level that it's been, both in nominal and inflation adjusted terms. However, it tends to be a cause of a lot of inflation and therefore is correlated with inflation. So if you have exposure to it, it is somewhat of an inflation hedge. Whereas if you have exposure to the oil price, maybe you're eking out more cash flow. So that's where this company comes into play. What they do is they buy mineral interests. And if you've ever invested in mineral interests before, you know that they pertain to real estate. Each piece of real estate has certain rights. There's air rights, surface rights, water rights, mineral rights, so on and so forth. The mineral rights, of course, entitle the owner of the mineral rights to any sort of royalties derived from minerals that are extracted from that piece of land. And so you can buy land that has mineral rights. You can sell off the mineral rights individually. This company is a buyer of that. So let's just take a look at their website to give an idea of their fall 2025 investor present. Okay, so Kimball is a pure play mineral company offering a unique 10.1% annualized. That's irrelevant for our purposes, given that that's static and we're at a different price now. Provides ownership in diversified, high margin, shallow decline assets with zero capital requirements needed to support resilient free cash flow. This is important because mineral interest investing is inherently capital light. All you do is purchase the rights to what's occurring on a piece of land, and there's no additional investment required. There is, the operator of the mineral extraction is your revenue source. So they have to do all the work to extract the minerals, and of course they're utilizing that for their business, and they pay you. So it's a complete toll booth. However, it's not the reason that it's not the best business in the world, and everybody isn't into it. It's not as hot as like single-family home investing, and some of these assets trade at really high yields. The reason is because every royalty asset inherently declines over time. There's only so much oil underneath the earth in a given, location. Eventually, it will be completely extracted. Every royalty asset is like this. Even music royalties don't last forever because music goes out of favor eventually. So that is the deal with mineral and royalty assets. They decline. So of course it makes sense that the company would say that they are shallow decline assets. Interest in over 131,000 gross wells across over 17 million gross acres in the U.S., including highest growth shale basins and stable conventional fields. I'm not much of an oil and gas person, but as far as I understand, shale is the newer point of extraction, whereas conventional, they're not pulling it from shale. 98% of all onshore rigs in the lower 48 are in counties where Kimball holds mineral interest positions. In other words, they're pretty much in every active area of mineral extraction. Since IPO in 2017, Kimball has completed over $2 billion in M&A transactions, grown run rate average daily production by over 8 times, and returned 71% of the original unit IPO price by quarterly cash distributions. That's pretty good. We're 8 years out from that, and we've given back 71%. So pretty good. So I think it's probably pretty easy to see why an investment in a vehicle like this might be appealing, because it's essentially a toll booth on a commodity extraction. Literally, the point of Kimball is to distribute a lot of cash back to unit holders and then take what's left over and buy more mineral interests. Mineral assets are not compounding assets. In fact, they produce the most amount of money right at the beginning and then slowly decline every single year. However, the compound effect still takes hold in that the company continues to purchase more assets. Let's just take a look at their basin here, or excuse me, their asset resource. Okay, so if I understand this correctly, the red area is kind of like nomenclature of what industry professionals would refer to a certain area as. The Permian, Barnett Shale, resource plays. These are counties. I can tell these are counties. There's a few I recognize in California, Texas, so on and so forth. So I think that correlates to what they said. 98% of all onshore rigs are in counties. So those are just the locations where they have interest. And the red map appears to be, these are all the major, current hot resource plays right now, between the Permian, the Barnett, up here, the Bakken Shale, and the Appalachian Basin. So we're more or less covering all that. Pretty cool. And then the blue just is kind of a more broadly defined USGS basin. 14 plus years of drilling inventory remaining. So again, oil and gas engineers are smart enough to, back into how much, on an estimated basis, how much inventory is left within this, area that we're drilling. And that gives an idea of what, is it viable to, go here, but there is some risk involved in just drilling any random area without knowing that there's, play there or not. Here, I'm trying to talk like I'm some oil and gas guy. I really don't know a whole lot about it, but know enough to talk through this. This is interesting because, again, we IPO'd 8 years ago. We've returned 3/4 of the investment. So it's, 6 to 8% per year. In other words, it'll only be a few more years until the entire $18 original unit price comes into play. At that exact same rate of ROI from today's price, again, just making assumptions, but at that same level of return, we will definitely get all of our money back in 14 years plus some. That's why this is important. And that matters when you're talking about royalty assets. How soon can I get all of my money back and then play with house money? Our decline rate, 14%, I believe means exactly what it sounds like. How quickly are our assets declining? Net royalty acre position of approximately 158,000 acres across multiple producing basins. Actively hedging for 2 years. Positioned as natural consolidator, that's true. Kimball will continue to opportunistically target high-quality positions in the highly fragmented minerals arena. Significant consolidation opportunity in the minerals industry with approximately $700 billion in market size and limited public participants of scale. I believe there are other investments like this that are pure play mineral aggregators. However, this is the only one that I really know anything about. Here's a snapshot of our revenue by basin. You see a majority of it is the Permian. I'm not even going to attempt to intelligently talk my way through how to interpret this other than what I can observe. What I see here are revenue by the Permian 54% and production 44%. So there's a slight premium on what's coming out of the Permian. So you do see that there is heavy exposure to the Permian. However, we have plenty of other areas as well. 88 active rigs drilling on Kimball's acreage, representing approximately 17% market share of U.S. land rig count. So we had oil, natural gas, and natural gas liquid. And here we've bought a couple other. We're not just buying outright mineral interests, we're also buying other aggregators here. You notice here they're either paying cash or they're paying cash and equity. That's another feature, not bug, of the MLP structure. Companies who do organize as an MLP do so that they can raise more equity. So it's a lot easier to figure out what the cost of their equity capital is than common stock for a regular old corporation because of their distribution policy. And then you see here the quarterly distribution in the light blue. You notice there's some volatility there. We'll talk about that in a moment. Run rate, average daily production growth by barrels a day. Our acreage numbers include mineral interest and overriding royalty interest. They continue to accumulate acreage, which is continuing to accumulate cash flow. I don't think I've ever seen something like this in a deck before. They're saying they're the only company in the New York Stock Exchange and NASDAQ universe with double-digit yield. That's, at least a small cap that has a low debt to enterprise value and has the tax-deferred distribution. So here, among all their basins, you see, here are some of the operators. Occidental, ConocoPhillips, Exxon, that's in the Permian, lots of names there. Devon, EOG, Proterra, lots of names that I recognize, a lot that I don't. Upside location, acreage in Colorado or California. Upside location drilling inventory. So I think what they're doing there is they're just saying we have more drilling inventory across properties. This is how many wells. 6.5 net wells are needed. So they're saying 5.1, 2.89 net. Add that up, that's more than the 6.5 to make flat production. Flat production is important because if we keep flat production, then we're completely fluctuating based on the commodity price. However, if production is increasing, then prices might come down or whatever, but we might have more revenue. If we continue to gain acreage, then our production per unit might fluctuate, but our production should go up, which, again, the compound effect at work. As long as they continue to acquire more interest and those interests perform, then there's a modest compound effect. However, the place that this has in a portfolio like mine, exists to provides some convexity of cash flow, like I discussed earlier. When inflation is higher going up, that asset booms, producing a little bit more cash flow than during typical times, and that cash flow can be deployed into other assets. So my primary focus with an investment like this is not to continually reinvest the cash flows from it into itself, but to siphon that off into other assets as it comes through, to perpetuate the cash machine, right? And then here our red line is that market share statistic that they discussed. Pretty significant toehold in the market. Invest in these units, you've got a pretty big slice of United States oil and gas production. You're susceptible to the prices, you're susceptible to supply and demand. That's the best and worst quality of the investment. 88 active rigs at no cost to us, 68% are operated by public companies and 32% by private operators. Every single breakdown here. This stuff is getting a little bit complicated for me, and it goes a little bit over my head, so I'm not going to go into it too much, but all those numbers look good. I'm impressed by how thorough this presentation is. Kimball has nearly quadrupled proved developed reserves since 2017 through a combination of acquisitions and organic growth. Here's some acquisition. Mineral interest. This is interesting. Mineral interest generally senior to all claims in capital structure. Many states' mineral interests are considered by law to be real property interests and are thus afforded additional bankruptcy. Mineral interest owner entitled to 15 to 25% of production revenue. Interest owner. So in other words, that gets paid out before the money ever comes to working interest owner. In other words, the operator. That's interesting. I didn't really consider that before. That's super interesting. I would urge my viewers to, if you're interested in this particular company, to pull up this presentation and read through it with anything that you feel you're interested in learning more about, because it's very, very detailed, and we just simply do not have the time. Like here, they're actually giving an overview of what the mineral and royalty interests are. Very interesting, right? Somewhere, okay, that's the end of that. So let's just take a step back and let's look at their. We've got enough history here to take a look at their financials. And we'll go as we typically do from an annual basis. Again, remember we IPO'd in 2018, so we'll just go from there. So our revenue, you see here, they have nearly a 100% gross margin, right, as they should, because it's so asset light. That first year of history, 67 million of revenue versus 62.5 of gross profit. So that's almost 5x here. That's been almost exactly proportional. It might be worth it to read the footnotes in the financial statements about, what they're deducting. What are these costs of revenues exactly? Because honestly, I would think that they should have 100% gross margins, but I'm not an accountant, so just something to keep in mind. We see here SG&A goes up not as fast over that time frame. Very encouraging. Other operating expenses also not as fast. So our operating income has gone from 19 to 123 million. So our operating income grew faster than gross profit. That's the hallmark of an economic model that can produce phenomenal results over time. We've talked about this many times. When we look at statements, again, we're not diving in super deep here on these videos into the statements. Sometimes we are, but typically we are doing a very simple eyeball check on how fast are the revenues growing, how fast are gross profits growing in comparison how fast is operating income growing in comparison. And I'm not surprised by anything I'm seeing in these numbers. Earnings from continued operations, you notice how they include unusual items in there. That might have been, I see that there's a lot of kind of one-time expenses there, probably had to do with the IPO that maybe they amortized over a couple of years. It's a little unclear. So it's kind of hard to read into those numbers. Don't want to read into those numbers too much. And you see that that also impacts this bucket here. The typical thing for an MLP to do is to issue a lot of shares. We noticed that a lot of the acquisitions that they made, they were doing so with a combination of cash on hand and equity. And we see here that their share count has gone from 18 million to 85 million over that time frame. That should not alarm you because of the structure of the company. While that might alarm, you know, me if I'm looking at a common stock of a typical corporation, it does not alarm on an MLP. And then we see here the dividend per share. It's gone up a little bit. It's been volatile from period to period. Of course, 2020 was a bad year with just oil being in such a glut of supply. It's modestly risen, from just over $1 out to what it is now. EBITDA from 44.4 million to 248 million. Again, a little bit more than 5 times. So that actually grew faster than revenues, not quite as fast as operating income. Income statement looks pretty good to me. Let's take a look at their balance sheet. 34 million in cash doesn't sound like a lot, but it's certainly more than they've ever had. AR, we know what their AR is. Here's the value, gross property, plant, and equipment. So that's effectively, the value of their interests. $2 billion. Not bad, right? Although they're accumulating depreciation, which is a little, I wouldn't think you could accumulate depreciation against mineral interest. So maybe that's something else. I don't know. I'm just kind of making guesses here. Current liabilities only $16.2 million. Again, they have more than enough cash in the bank, not just current assets, but cash. Be very weary when looking at the current ratio. Again, a company can have very little cash on hand, but a lot of AR and have a good current ratio. So don't look at the current ratio. Look at cash on hand versus current liabilities. That's what I would recommend anyways. But that looks pretty good. Long-term debt, they do have 462 million. Again, I assume that they're using the debt to make acquisitions. The 4 big acquisitions they talked about in that investor deck had, they either said cash or cash and equity. Reasonable to assume that some of the other activities, the other acquisitions they're making, they're utilizing debt to do so. Again, you see shares outstanding, issued quite a bit. So again, knowing they have more cash on hand than ever, however, cash per share not as high as it once was. Also interesting to look at is this tangible book value per share. Although their tangible book value has gone up quite a bit, tangible book value means that an increasing proportion of their assets have been funded through debt. We see that on this. But another thing that I'm, thinking through there is how do you value, book value. So book value would be what you paid for it. At what point do you write down a royalty asset to zero? Something interesting to ponder. So I'm a little perplexed by the book value per share piece. I get that we've diluted, we've issued a lot of accretive shares that have driven growth over time. Um, I would think that if it was accretive, though, it would at least stay constant in terms of book value. So I'm a little taken aback by how that looks, or I'm a little confused by it, but it doesn't necessarily concern me. I should probably look into that more. Here's our dividend history. You see, of course, oil prices were exceptionally low here. Let's just go back all time since IPO. It's been relatively high all time. See here, the distribution on 8/11/2022, 55 cents per unit. That's the all-time peak, August 2022, and that was coinciding with the peak in oil prices, right here, right? So the distribution has tracked inflation fairly well in terms of the oil price, and that's, I think, all you can ask for with an investment in this. Let's take a look at the valuation. Price cash flow multiple, 5 to 7. Price sales, I would expect that to be on the higher end. Enterprise value over EBITDA, 7 times. Price earnings is irrelevant because this is an MLP. 7 times EBITDA is pretty good. That price book ratio, again, I'm confused by the book value there. I wouldn't expect it to be necessarily lower than that. It is higher here. We know that makes sense. It's higher because of what we've seen. Enterprise value over EBITDA, typically hovering around a 10. Not sure what's going on here. This is the 5-year average column. So we're below, we seem to be below the 5-year average multiple. Dividend yield over the last 12 months, 12%. That's a little bit higher than what we're looking at. Speaking of which, we looked at the dividend amounts. Let's look at the yield. So, interestingly, the stock has, more or less been right around 10% for the majority of the history. There was a lot of volatility here. It probably got so cheap at one point. It sold off so much, but then the yield came down because it recovered, but also because the payout went down a lot. So we just had some volatility here. But aside from that volatility, we've more or less hovered around 10%. More or less hovered around 10%. So I think the valuation, I think looking at the yield is a good measure of valuation here. Hovering where it is now, 10, 11, 12%, seems perfectly fine. And then our price cash flow, EBITDA multiples look good. How many multiples of EBITDA would you be willing to pay for an asset-like business? Frankly, I'm a little surprised that it's that low. How favorable the economics are. I'm curious about this, just to take a look. I want to take a look at the total returns. Been flat over the last year. Oil prices, of course, tanked really hard on tariff volatility, and they have not recovered, right? They were 70 something a barrel, tanked below 60, and we've recovered about halfway. You see that more or less. Let's look at futures. So you see there, obviously, KRP and crude futures very highly correlated, right? Much more correlated than to the stock market. However, 3 years, we see crude down 21% because of these distributions. Kimball Royalty has exceeded those returns quite a bit. And how about this? Over 5 years, again, coming out of a COVID low, 5 years ago was September 2020. Okay, so take that with a grain of salt. But it's crushed the stock market. And it's also crushed crude oil. So despite the fact that the daily moves, here's what's important. The daily idiosyncrasy of the price highly correlated to oil. If oil is up 1%, 2% in a given day, this stock is probably going to be up 1 or 2% on that day. But over time, the deviations outside of that kind of daily beta have produced outperformance due to the distribution being reinvested in this particular analysis. And then we see with less trading history, here has outperformed crude, but not quite the stock market. So that's kind of what I was talking about before, where it's not one of those things you should look at, also underperformed here, not one of those things you should look at and expect to outperform the S&P 500. However, there's idiosyncrasy in the cash flow and idiosyncrasy in the daily movement of the price that might be helpful for diversification purposes. So that's a good segue to talk about the risks. And I think it's pretty clear what the risk is here. The risk is you're just completely susceptible to the commodity prices, which can be very volatile. Recently, within the last 6 months, almost exactly 6 months ago, as a matter of fact, oil went from, like we said, 71 to 59, $12, very volatile. And it hasn't recovered, whereas the stock prices have. So that's kind of a double-edged sword, because what that means is the valuation of these units here is actually quite attractive right now. Right? It hasn't quite recovered. But it also means that, again, you're getting a lot of volatility both on the up and the downswing in moments where you don't necessarily want volatility. So that's really the risk of this investment. It's not really a defensive investment. It's an inflation defensive position, but it's not something that's going to be green on a day when stocks are red, right? Just as a general rule of thumb. So that's really the main risk. I mean, it doesn't even bear worth repeating much or going into some of the other more benign risks we have. There needs to be continued new wells and new production and new all that. Oil prices need to, be conducive enough to new drilling, all that. So obviously that's simple to understand, but the fluctuation of the oil price can be very volatile in both directions, and that's probably the exact reason why investors want exposure, but it's also the worst quality of the investment. So that's our risk. That's the main risk to worry about. Let's take a look at the technical analysis here. I'm going to zoom in. Again, this is our COVID low here. Traded all the way down to $250 a share. Woo! All these energy MLPs, man. If I would have just, I did buy a little bit of Energy Transfer at that time, but man, if I would have bought more of it at that time, all this stuff is up, 5 to 10x off the March 2024. So, but yeah, I mean, look at this chart. Let's kind of zoom out here. Just like technical analysis on this name is a little bit, I think, less important because oil, and there's also natural gas prices, but oil is not a stock, right? Some stocks, stocks trade on supply and demand of the shares, and that's correlated to the earnings changes. Oil also trades on supply and demand of oil, not of the shares of this company. So because of the sensitivity it has to oil, it's not, I think, as meaningful to do technical analysis on commodities, I guess is what I'm trying to say. But nonetheless, we'll do it. Here we see, if we fell off of a floor and we've made it back into that. We traded off this, channel here, this trendline resistance, and down to support here. So really, much like the oil price, you see the oil price here, we don't actually do technical analysis on it. But we know that, again, KRP did not reach an all-time high here, but whereas oil did. Just to give you an idea. So you see how it has outperformed. Anyways, oil has been sliding down. It's been in a downtrend since this time. KRP has been in this very modest descent of this trend here, while hugging this support with the exception of what happened here. But you do see that there was we bounced off this temporarily right here. And then we fell right through it. recovered up above it, traded down to it, and up. So we've got a pretty good support line here. Recently, we traded all the way down to there, and we're back on the upswing. So I think something to watch is obviously watch the oil price if you're doing technical analysis on this. But we're kind of in the middle of this consolidation, and do we break out of this? That's what to watch. I think technically speaking, where we're at now is fine. I don't have any concern about adding right there. I would if we were, closer up to the top here, not seeing a breakout. I'm also not a trader. I accumulate for long-term hold. But yeah, pretty simple chart. We don't have the volume on this. I should figure out how to import the volume on this if I can. But yeah, we've got this kind of like wedge formation where we're approaching the horizon, and it'll be very interesting to see, the convergence of these 2 points is a little bit higher than where we're at now. It's like right above $14 is the convergence. You see the current price, $13.87. So I think the current level is adequate for accumulation for that exact purpose, because we're essentially at the level of this channel from a technical perspective. No real concerns, no real bullish looking chart either from that end. So that's going to conclude the video today. Hopefully you found this interesting. I like this MLP. I like MLPs in general. I do have units of this. I've been accumulating them, over the course of this, period where it's been, a bit of a low point. I didn't have any sort of pure play oil and gas exposure. Lots of energy through pipeline MLPs, but not through just pure play commodity exposure. And I felt that my portfolio needed that. I felt that this MLP was the best way for me to gain exposure to that. However, before investing in an MLP, please make sure that you understand, or that you're willing to learn, how the tax implications of doing so, because there are additional administrative burden to holding MLP units. But it's fine with me. Happy to do it myself. So look into that if you have not already and you're interested in this one. So hopefully you found this interesting. Please consider liking and subscribing if you have. Feel free to leave me a comment. Let me know how I'm doing. Give me any suggestions on stocks or MLPs or whatever you want me to look at. Happy to do that. And thank you so much for watching. I appreciate you. We're almost at 400 subscribers, which isn't a lot, but it certainly is a milestone. I'm excited about that. So really appreciate all of you out there for watching. And this has been fun. So that'll conclude us today. And until next time, hope you have a great rest of your day and a good evening. Thank you for watching, and I will talk to you later.